What's up, everybody? It's Austin here. If you've been paying attention to the market, you've seen that growth stocks have rebounded pretty sharply. We were way down, bear market territory, everybody was scared, and then the last few weeks or months, the market has just rebounded sharply. You saw it in my portfolio, which I'm going to share in just a second, but I'm talking about 6 companies today that are still 25% or more down from their highs year to date. And I'm gonna talk about each one of them and tell you if I think they're undervalued, maybe a fair buy, or overvalued right now. The 6 stocks are Adobe, Salesforce, ticker is CRM, Intuit, INTU. It's the only one out of these that pays a dividend. Atlassian, ticker is Team, Servicenow, NOW, and Hubspot. HUBS, which Hubspot is the smallest out of this group. So we got a little bit of everything, large cap, mid cap, and then smaller cap stocks, okay? I always share my portfolio. We're building this thing from $10,000 to $1 million. We're adding money every single month, and I share every step of the way right here on this channel. We started it February 16th of 2022. We have put in $86,444 and is currently worth $98,804 for a total gain of $12,359. So that's pretty good. Here are the companies I own, and just for your awareness, I'm not talking about these stocks today. I don't own any of the companies that I am talking about in this video, but I'm considering them for potential positions in the future. If you want to get my stock research and live updates when I make transactions, which I'm a long-term investor, so it's not like I'm day trading, austin.substack.com, there is a link to that in the description below, so check that out. All right, let's jump back over to these stocks, okay? We're gonna talk about some of the similarities and differences. These are all software-based stocks, right? So when we think about software-based stocks, we think about recurring revenue, so they have like monthly subscriptions from their customers. Think about high gross margins. They're not out there manufacturing cars or houses or selling shirts, like this awesome shirt I'm wearing in retail. So that means that it's generally cheaper to sell the products that they sell, so they're gonna have higher gross margins than an auto dealer like Ford or GM. Okay, so that's the type of stocks we're talking about here. From market cap, from largest to smallest. Adobe is the largest at $208 billion, then Salesforce at $188, Intuit at $137, Servicenow at $102, Atlassian at $72, and HubSpot at $18, okay? Now, let's jump to how these stocks have performed. So still, 10 years, I mean, just look at these 10-year returns, and these are the types of stocks I like to own. Long-term, proven winners, not flash in the pan, the latest, hottest stock. I don't generally like to do that. I want to own strong companies with strong management, strong histories, good products, and a history of beating the market. Adobe's up 1,200% in the last 10 years. ServiceNow is up 1,500% in the last 10 years. Crazy. Over the last 3 years, it's a little bit different. Adobe is up 54%. Salesforce is up 34%. Intuit's up 81%. Imagine that, beating Adobe there. Atlassian's up 97%. ServiceNow's up 95%. And HubSpot, the smallest of the bunch, is up 104%. Now, let's look at year to date. The one that's down the most is also the one that is up the most in the last 3 years. That's kind of crazy to think about. HubSpot is down 41% year to date. The next biggest loser is Atlassian, down 25.7% year to date. Salesforce down 25.3%, almost beating Atlassian on the downside. And then Intuit down 24% and Adobe down 21%. Okay, so these stocks are still off their highs. Now, they have bounced back. This is crazy. HubSpot is the biggest winner for the last 3 years. It's the biggest loser year to date, but it's also had the second strongest performance over the last month. That's a crazy trio of statistics there. HubSpot's up 41%, Atlassian's up 47%, Intuit's up 26%, ServiceNow's up 21%, Adobe's up 18%, and Salesforce is up 14% in the last month. All right. Now, like I said, Intuit is the only one that pays a dividend. So if you're looking for dividend stocks, really, you're not really considering any of these other than Intuit for a potential dividend growth stock. But this is the only one on the list that pays a dividend. Payout ratio is only 20%. Their 4-year average yield is 0.64%. You can see that the current yield is lower than its 4-year average. The way that happens is that means that the stock price is probably higher than it has been traditionally. The PE ratio is probably higher than it has been traditionally because the stock price is When the stock price goes up, the dividend comes down. If the stock price goes down, the dividend goes up. So that's an indication that Intuit might be a little bit more expensive on a share price and a PE basis than it historically has traded at. So that's something that we'll want to look at. But you do get strong dividend growth here. You get a 3-year dividend growth rate of 13% dividend CAGR and a 5-year dividend CAGR of 14.87%. It's paid a dividend, it's grown its dividend for 9 years and it pays it every quarter, okay? Very safe dividend, A+ rating, dividend growth is an A, dividend yield is D, we talked about is pretty low, and then consistency is A-. All right, now let's look at PE ratios, right? In PE ratios, it's okay to look at some of these under PE, but as you can see, like Atlassian here is at 180, and that's just because they intentionally are kind of not having earnings so that they can reinvest more for growth. Same thing with HubSpot. Those are two of the smaller companies of this group, and so the PE naturally is the highest, right? But let's look 3 years out, right? Because we're long-term investors, okay? And that's what we'll look. And this is based on expected earnings. So the lowest out of the 6 is Adobe at 23.7. Then we've got Salesforce at 27.39, Intuit at 29, Atlassian at 80, Servicenow at 43, and HubSpot at 87. So those are pretty high, right? That's a non-GAAP PE ratio. If we look at growth on these, so we're looking at revenue growth forward. We want to see what is expected in the next year. Adobe's at 16%, Salesforce is at 20%, Intuit's at 23%, Atlassian's at 30%, ServiceNow's at 25, and HubSpot's at 33. Remember, the ones that had the highest PE, right? If they have a higher PE, we expect them to be growing faster. That is the case in this scenario. HubSpot's expected to grow 33% their revenue. Atlassian's expected to grow 30%, okay? But does that higher growth rate justify the higher PE ratio? And that's what people have to decide. And I'll tell you a couple ways that we can figure that out. We want to look at their revenue growth, which we talked about. We want to look at their gross profit margin and see which one is actually more profitable per sale of their product, essentially. So Adobe has an 87% gross profit margin, Salesforce 73%, Intuit 83%, Atlassian 83%, ServiceNow 77%, and HubSpot 80%. So when we look at the two most expensive stocks on a PE basis, got Atlassian at 83% gross margin and HubSpot at 80%. It is better than ServiceNow. It is better than Salesforce, but it's basically the same as Intuit and Adobe, right? Now let's drop down to net income margin. Adobe's almost at 30%, Salesforce is at 3.5%, Intuit's at 19%, Atlassian's at minus 21%. We talked about that, investing for growth, right? So naturally their net income is going to be lower. The question is, can they get to scale? Can they eventually get to a 30% net income margin, which not a lot of companies can? That's one reason Adobe has been so successful. We talked about that 10-year performance mark for Adobe, right? And same thing, Intuit, 19%, still very high. ServiceNow is at 2.7% and HubSpot's at minus 6%, okay? Another thing I like to look at with stocks is insider ownership. How much of a percentage of the company do insiders still own? That's management, that's people on the board, to show if their interests are aligned with long-term investors, okay? A higher number can be good. It's not a make or break necessarily. Great companies have had low insider ownership, but it's just something I like to look at. Adobe's at 0.27%. Not high, but we see the performance of Adobe over time, right? Salesforce, 3%. Intuit, 2.75%. Atlassian, 43%. So the highest there. You would think that that management has the most incentives aligned with their shareholders. ServiceNow, 0.2%. And HubSpot at 4.9%. Okay, we can see the performance of these stocks. If you look over 3, 5, and 10 years, all pretty strong performers. What we need to figure out is, are these stocks good buys now or not compared to historical averages? This is fast graphs. Sometimes I go more in depth here, but we're going to try to speed through this. And we're simply looking at, is this black line below or above what it has historically traded at in terms of multiple, okay? For Salesforce, we're looking at price to sales ratio just because that's the best way to look at this stock. And so its normalized price sales ratio over the last, since 2004, has been 8.29 with 28% annual sales growth on average. We can look, it's currently at a blended price sales ratio of 6.4, so it's below its historical average, but it's not going to grow as fast. It's expected to grow 17, 18, and 17%. So if we go to forecasting and we see what the forecast is, I don't expect it to get back up to that 8.29, but let's see if it just stays at a 6 or something like that. So if it stays at a price sales ratio of 6, which is pretty much what it's at now, below its historical average, you're looking at through 2025, January 1st, 2025, you're looking at a 52% total rate of return. Not bad. Okay, let's jump to the next one. So if we go to HubSpot, we can see since 2013, it hasn't been public as long. Its normalized price sales ratio has been 10, 32% sales growth rate, and right now it's actually trading at 11. And so if it stays up at its price sales ratio, its average price sales ratio of 10, you're going to have 50% annualized rate of return through 12/31/2024. Jumping to Intuit. Okay, Intuit's another one. If you look at it on a price to sales basis, its normalized has been 6. It's currently at 10, but let's look at operating earnings. Even on an earnings basis, a PE basis, it's trading at a blended PE of 41. Historically, it's traded at 29, and earnings have grown 16% per year. But moving forward, it's expected 20%, 18%, 17%, and 15%. So above its average, right? If you go out to July 2025, that's not a great return, 14%. So I'm going to hold off on Intuit, even though it's a fantastic company. It's just too expensive right now. Servicenow. Okay, so Servicenow on a PE basis, it's actually better to look at a price of sales just because earnings have been, mostly negative. Since 2011, it has traded at a normalized price sales ratio of 14, and right now it's trading at 15, okay? But we actually, with this one, we can see how ridiculously high it's been since COVID, so we actually need to take that out to get a more realistic PE ratio, or price sales ratio, 27% revenue growth. 13 price to sales ratio. Let's go to forecasting. Right now, we're looking at 23% over the next 3 years and a normalized PE ratio of 14. It's trading at 15 right now. So sales growth is a little bit lower, but still pretty strong over the next 3 years. Let's take it out. If it trades at a price sales ratio of 14, then you're getting a 58% annualized or total return through 12/31/2024 for 21% annualized. Even if we bring that down, to 11, which is lower than its historical average for almost the same sales growth, then you're looking at a 26% total rate of return through, remember, this is a different range. This is through 12/31/2024 and an annualized return of 10%. So let's get to Atlassian. I think this might be our last one. Maybe we have one more. I don't know. If we go to max, since 2015, the normal price to sales ratio has been 19, but again, we're going to have to remove post-COVID because of just how crazy it got, which brings that normalized price sales ratio artificially high, and it's had a sales growth rate of 31%. If we take post-COVID out, then the normalized price sales ratio is 16, and let's look at forecasting. 16 is going to be our baseline. They're expecting 28% revenue growth rate. It's currently at 24. If we bring it down to 16, you're still looking at through 6/30/2025 a 32% total rate of return, which is 10% annualized from here. So even if that price sales ratio comes down from 24 down to 16, if they hit these sales growth estimates, which they could miss them, you're still looking at a 10% annualized rate of return. Okay, if they do a little better and the price sales ratio is 17, then you're looking at a 14% annualized rate of return for 48% total return. And so that's the picture for Atlassian. And that's the last company for today. So would love to know, do you own any of these stocks? Do you think I should dive deeper into any of them? Right now, my opinion is that I like my current companies better than these given the return scenario.